Okay, so what's our specialised subject today?
Okay, well, I thought we'd take a look today at the role of moving averages, or the role that moving averages can play.
Okay.
And I picked a chart here of Centrica, nice and topical, because they obviously had figures yesterday.
Which disappointed the market, didn't they?
That's by the by to some extent to this, but it does sort of, focus your attention on the price action perhaps that happened beforehand. So for those that aren't aware, probably best to give a brief summary of what a moving average is. And it is simply that. It's a rolling average of the price over a fixed period of time. And that people plot them on all sorts of period bases, typically 5, 10, 15, 20, 50 and 200 day. I like what's called an exponential moving average. Sounds complicated, but all that means is basically that the moving average is weighted, and it's weighted in such a way that the current price action
has a higher weighting.
Counts for more than what's called.
Because there's simple, there's weighted, there's exponential, isn't there?
Yeah.
Okay.
Absolutely.
Now, in terms of the time frames, what's your advice on that?
For me, and everyone tends to have a different view, I follow 20, 50 and 200 day. I'll get quite a bit of criticism about using the 200 day EMA because people tell me it doesn't make any difference. I disagree, and I think it can be a very powerful tool. And perhaps the easiest way to demonstrate what I mean by that is to turn to the chart.
Slides. Okay.
So for the benefit of those watching, the 3 time periods, 200 day EMA in red, the 50-day EMA in the orange line, and the 20-day EMA is the turquoise line. But look, we can see straight away that Centrica has respected its 200-day EMA on a number of occasions, 1, 2, 3. It basically touches and bounces off. And so what that line is telling us is that when it's on its 200-day moving average, for the most part, the market believes that the stock is too expensive. And that's a great reference point for anyone plotting a trade. We got quite bullish on Centrica in here, in late Jan, early February.
So would you trade off moving averages?
Well, I think what I would do, and what I do tend to do, is to use them as a reference point. If we fail at a moving average, then I and consistently do that. I think that that's a clear indication of a top. If we break above a moving average, what I want to see is that move sustained. Because look, if we come back here to the spring last year, we see Centrica breaks above the 200-day moving average, but it's unable to hold it. And in fact, it flies up what you might like to think of a high wave candle, I suppose, or rejects, and in fact the next day gaps down sharply. So if you see a break above, you want to see confirmation. A confirmation probably warrants a substantial move through it, or a period of where the move above is sustained and ideally is accompanied by volume, and you really were looking for probably for a couple of days worth of confirmatory data, if not a bit longer, and where we find, in this case, the 200-day moving average as a barrier. 3 times here, for instance, 1, 2, 3, 4, perhaps you could say. Back there in June last year, it tried to break above the 200-day moving average and failed. And that's telling you that there's no appetite amongst the buyers of the stock, the bulls, if you like, to take the price any further. Well, when it comes down to it, all trading is about that balance between supply and demand, that war between the bulls of a stock or any other instrument and the bears, and who ends up with the upper hand. And what the moving averages do is effectively draw a line in the sand which can often be that sort of final hurdle, that point beyond which it won't stretch. Clearly, if we could find a chart where the 200-day moving average is below the current price, then there's the chance for that to act as a level of support. Okay, so let's just talk about a couple of themes there. Historically, fund managers have not used technical analysis, and if they do look at the technicals, it's suggested they'll just look at the 200-day moving average as a roadmap. And in terms of as a reference point, if the market's trading above the 200-day, bullish, below it, bearish. Is that too old school? Is that too simplistic? I think it's something of a guide, but I think you need to understand the reasons why. The fact that just because something is trading above its 200-day moving average, you need to know what might be driving that. I'd try and look a bit deeper and find out what the fundamental reasons are. Has there been a change in the, if you like, in the expectation of that stock?
Right.
Are we expecting a period of growth? Have they got a new product out that's that people think is going to knock the socks off the competition? That kind of thing. I think it's probably too simplistic of you, to be honest, to say it's it's always good to be above the 200 average. It's always day moving average. It's always negative to be below. I think you've got to look at it on a case by case basis, to be honest.
Okay.
Maybe you could use that on an index, on a broader index type basis, but I don't think it's necessarily applicable.
Okay, so my next question is that Japanese candlesticks, I think, give you the quickest reversal signal of all technical analysis, because you get one nasty candlestick or one very nice candlestick, and it shows a clear distinction between supply and demand. Whereas I would be critical of moving averages that they're a laggard, not a leader.
I think that's probably fair.
In terms of the longer term averages, anyway.
Probably fair to say because they are backward looking, because we're calculating an average from the historical price movement, including today, and just moving forward one period at a time. So there is some truth to the fact that they are a laggard, but that's perhaps why I prefer to use the exponential moving average, the weighted average, where we're factoring, you're placing more importance on the current price action than you are on the historical. That you're still referencing what's gone before, because I firmly believe that markets have a memory, even if a lot of the participants don't. And I think, in some respects, that's what the moving averages are plotting. They're plotting the market memory for that particular stock, and the price action and the sentiment around that stock. In this instance, back to 200 days and beyond.
Okay, so there's lots of trading systems out there, and in the simplest form, I would say that this gives you the ability to build a system around the moving averages, because you're either above a level or you're below the level. There's no second guessing. And what I would say is that there's lots of fancy courses out there that people go on, and they'll teach you about moving averages. And there's so many books written on this subject, isn't there? Yeah,
there are. I mean, it's not, of course, this isn't the only use for moving averages. One of the other things, though we haven't got an example of that per se on this chart, but where we see a moving average crossing over the other. So, for instance, here the 20-day line crosses up through the 50-day line. So what we're seeing there is near-term price momentum as the shorter-term moving average turns higher, and that would be termed a golden cross, potentially the net. But the flip side here, we see the 20-day moving average crossing back down below.
Right.
50-day.
So again, that raises another point. They're not great in sideways markets, are they?
No. If the market's not directional, then no. Then all it's telling you is what you can already see. So, but what they can do, is reflect key price points and highlight momentum changes that really matter. So when we're seeing a turning point and a break above a moving average, we haven't necessarily got that on this chart. But if we had continued strongly through the 200-day moving average above £3, then that might be telling us something slightly different about Centrica. As it was a warning sign to say, actually, the stock's had enough, there's exhaustion now, and we're going in the other direction. What we probably couldn't have predicted is that we were going to gap down all the way to 260. That was, unexpected news yesterday. But the warning signs of a change in price action, a change in sentiment was certainly there after that rejection.
Darrenson, the market commentator, Admiral Markets, thank you very much for coming in and doing that. Teaching, if that's the right word, on moving averages. Okay, that wraps up the trading segment this morning. We'll be back at 10 o'clock. Got an action-packed show today, and we'll be back at 8:30, the 8:30 slot with Stephen Woodcock, ahead of trading at TradeNext on Tuesday morning. That's Tuesday morning, no trading show first thing Monday morning. Have a good day. Thank you.